G'day Internet, Max right here, and today a little bit of a treat for the channel. Now, as you guys know, mostly I'm into Bitcoin and things like that and keep you up to date there. But I hope you also know I keep a very, very close eye on the real estate game because I really, really want to ape into real estate when the time is right and just get massive amounts of cash flow coming towards me. And our guest today is someone who's in a very unique position. I've been following her for several months now, and she's in a very, very cool position in the mortgage world, in the US mortgage world to be specific. And I've been following her content, keeping an eye out for when, there's possibly going to be, let's call it a calamity, a crash in the housing market, whereby the opportunity will be right for us to jump in and buy up that cash flow for pennies on the dollar. And so with that, Melody, I'd love to welcome you to the show. Thanks for being here.
Thank you so much for having me. It's a pleasure.
Why don't you kick it off and give our audience a little bit more of a detailed explanation about your background and your unique insights?
Yeah, so it's kind of wild. I started out in academia, thought I was going to be a professor or something like that, but quickly learned that wasn't right for me, just in terms of you're never going to make any money. And then also, I think a lot of academia just gets stuck, and so I didn't want to talk about the same thing for the next 50 years of my life. And so I had to get a job that would pay my student loans back. So I fell into mortgage finance, which is pretty much how anybody gets into mortgage. You don't, mortgage means death pledge, in case anyone didn't know. And so you don't just grow up wanting to be a mortgage. It's very rare. And so I went to for an interview in Minneapolis, Minnesota for a project analyst job. And the guy was like, "Hey, what made you want to work at a mortgage company?" I was like, "Hey, I didn't realize this was a mortgage company." And that was September of 2006. And I started there. And it was, I mean, it, the timing couldn't have been more perfect. We had just been, in terms of how I came to my knowledge, we had just been purchased by Cerberus, which is private equity. You guys may know them now. They're participating in this long-term rental market with First Key Homes, but they purchased us, and very quickly they could see the writing on the wall. Things were slowing down, and they wanted a purchase price adjustment, and so I kind of became their girl Friday, going out across this huge organization, gathering management reports, teaching them about the business. And sure enough, they realized that things were really slowing down. And so we took our write downs very early. We led all of the market in this. And so folks like Bank of America, Chase, they didn't follow for quite some time. But pretty much from that moment on, it was just full panic, craziness, strategic alternatives. I come into the office and be like, "Oh, we're writing down 800 million today. Oh, we're writing down 300 more million today." And this was just day after day after day. So it's just complete chaos. And I sat in corporate finance at the time. And 2009, we spent the entire year in the office, 185 days straight, pure madness. And then, we got TARP funds. And this is what it kind of saved us. We had this small, tiny bank in the middle of nowhere. So GMAC became eligible for those TARP funds because of this tiny bank in Utah. We were not a bank holding company. So there was a lot of machinations that occurred for us to get those TARP funds. So we kind of went on life support for a few more years. There was a tiny refi boom in 2010, but it wasn't enough to save us. And so ultimately, after all of the regulation that came in for what was called the consent order and the AG settlement, put it this way, the banks were getting their hands slapped for bad processing of foreclosures. Ultimately, that sent us into bankruptcy, and I helped manage that bankruptcy, which was historic at the time because we continued to originate home loans while in bankruptcy, believe it or not. It was a very large, Buffett was involved. It was a very big deal. And then from there, my president said, "I need you to go fix default." And this was, 2012. After all of the shenanigans in the foreclosure market, they wanted me to clean that up because, believe it or not, we always talk about the big banks during that time being the bad guys, when in reality, the reason why we couldn't offer modifications is because these were government sponsored loans and they had very strict requirements on what we could and couldn't do. So this is a long answer, but ultimately I went on to manage default, spent a lot of time on the road going into different cities. And then, from there, as kind of my company got purchased, I went off to several other non-bank, what we call servicers and originators, because as Basel III really, those requirements became known, a lot of the lending moved to the non-banks. And so from there, I just tried to fix things, tried to make sure it could never happen again, which is why this is so crazy to me. And then I went off to fintech and created a whole bunch of, technology for the mortgage space. And then about a year and a half ago, I was just, looking around and everybody was talking about this inventory shortage. And everything I just knew that couldn't really be. And it was like looking at demographics and all these things and my understanding of the mortgage market and certain things that nobody understands, like the fact that the agencies do things like performing loan sales to investors. I mean, there's just all kinds of things that make this look very different than what is really happening. So I got on the road, went to Austin, Charlotte, Nashville, Florida, these big cities, and just started touring new home developments because there was all this inventory that's out there that's not being reported. And so that is really how this recent journey started. And I'm sorry for that very long explanation, but I just kind of want to give everybody an idea of how I came to my knowledge. And then being in corporate finance in a mortgage company, you deal in the capital markets all the time. And that is, I think, what a lot of people don't understand about housing in the US is driven by those capital markets, by the GSEs, by these government agencies. And so you're really participating in a market that most people don't understand. If they don't understand, that's honestly how they get burned. So
Understood. Now my mind goes in like 10 different directions here after what you've just said. I actually have a really good friend who is one of those non-bank originators, and he's just hemorrhaging cash at the moment. And we can talk about that, but I think I've only got you for a limited amount of time. I'd like to take it in another direction if that's okay. Let's talk a little bit about the challenges that homeowners are taking in terms of just servicing the property. I see this a lot, and just inflation is just hurting people in so much. Their taxes have gone up, their insurance have gone up, the cost to mow the lawns, every single thing has gone up, and it's tipped everything upside down. And it's not just in the real estate market, it's across the whole economy, to where we find ourselves that just affordability is just becoming an issue for houses, that there has to be something has to give. And this world of inflation, it's a world that I've studied a lot, and it's really, really hard for people to wrap their heads around. And I've come up with I think a fairly useful analogy to help people understand this. I think if I told people that unemployment was going to be, it was 20%, well, people would be, oh my God, like markets had crashed and everything, it would be horrific, right? And I was like, so with inflation, we've had over the last 2, 3 years, prices of everything that you consume, everything has gone up 20%. You've had no meaningful gains in your wages. In terms of demand destruction, what's the difference between a 20% unemployment rate where 100% and 20% of people lose 100% of their income, or 20% of inflation where 100% of people lose 20% of their income, of their
right.
purchasing power? That demand destruction is occurred, and it's a very analogous situation where 20% unemployment or this inflation, it's the same. So what has that meant to the real estate market, to the economy, to affordability, and how do you see those dominoes falling?
Yeah, I like your analogy. I think so. I've been saying for the past 6 months that I don't care if we have more job losses. It just doesn't matter because existing homeowners are coming under such significant stress. And I'm seeing it in my client books right now. Tax season in California just hit. And, a lot of people talk about, well, there's a limit on the assessment for taxes in California. And that's true. But if you're a new buyer, you got slammed with what they call supplemental taxes. And so all we need, and it takes time, that demand destruction, the destruction of our purchasing power, that takes a lot of time. I think people think it happens overnight, but no, it really doesn't. If you think that you're a prime borrower who's had these increases in property taxes and insurance, and then of course, just the regular upkeep of the home, typically if you're a prime borrower, you have some options. You might sell some stock. You might take out a loan from your 401k. You might sell an extra car that you had to be able to meet those expenses. But then as prices don't come down, you are still struggling because, as you say, wages have not come up. And so as all this persists for longer and longer, the consumer then gets in more and more trouble. And then if you do add on top of it a job loss, which we have seen ton of layoffs last month, then that just accelerates the path. And so, from my perspective, these price increases are killing people, and it's death by a thousand cuts. And it's not going to be overnight. And I think that's why people are still very confused about the economy. I think we've got some, recent news with the GDP, and also kind of the what's called the bed report that really, that's where they link the over 9 million establishments to see what, jobs we really lost or gained. And we are getting a clear picture that it looks like something last fall just really, fell off, and people stopped spending. And I think what we're going to see is that regardless if there is additional unemployment, although I do think there is going to be, is that we'll just stay on the sustained path, and you're just having small implosions all over the place due to these increased taxes and insurance. And right now, the places where you're seeing it are Florida, Texas, and California. And those are three of the largest housing markets in the country, and often lead what's going to happen in the rest of the nation.
Yeah, we saw. I mean, they're the ones I try to keep an eye on too. We saw in 2008 the Sand States nickname. That's the crash hit so aggressively there, 50-60% down in some cases, and but then also that was the greatest opportunity in the aftermath. Those states also went up the most afterwards. So I like to keep my eyes on those because that's the kind of places that I'm looking at purchasing. So affordability is an issue. Now, what about in terms of people who bought in all cash? Because there was a lot of that this cycle around, right? How does that kind of link in? That to me, this sounds like strong hands in terms of coming from the crypto market. It's the guys who don't need to sell. They've got the strong hands. They can hold through those brutal bear markets of crypto. Surely the all cash buyers can hold through the brutal bear market of that. Tell me how that works.
Well, first, all cash. We know it wasn't all cash. I mean, we live in a hyper financialized world where nobody spends their cash that way. It was leveraged off of things like crypto assets, off of equities, or places like PNC had a wealth management program that said, hey, listen, we want you to be able to compete out there. So we're going to give you an unsecured personal loan so you can have all cash to go buy your house. And so we cannot know how much that is, but I will tell you, we also know the institutionals are very leveraged and they play that game. So when I was recently in San Antonio, I did a great video there where American Homes for Rent, which is one of the larger institutional long-term rental owners, they are selling. They are a net seller in Texas. All four cities that they have those in, they have been a net seller this past year since 2022. Good example, existing home neighborhood was really nice, right next to a school. It looked like a half probably long-term rental, half ownership neighborhood. Americans Home for Rent tried to list it for about $1,800 in rent. That didn't work out. They put it up to $2,400. They weren't able to rent it. They got a tax bill for a 30% increase in taxes on that place, which ended up being like multiple, tens of thousands of dollars. And now it's been listed for sale with a $60,000 haircut. And so your institutionals understand as well, they need to get out. They're doing it more quietly. And a lot of times what they'll do is what I'll call all in the family deals, where they push them between each other. Starwood, Pretium, they did one of those earlier last year. So, there's a facade right now that the institutionals are doing just okay. You might have seen earlier today in the New York Times, the article on BREIT or the Blackstone Fund. And everybody's talking about like, wait, all these publics have taken losses. Why haven't you, Blackstone? Well, precisely because they aren't public. There's a lot of accounting, practices that can make it. They won't realize those losses for still some time, especially if they push things around to one another. And so, what I would say is that all cash wasn't all cash, and what is going to happen that's going to be a bit different from last time is that I think a lot of lending move into the private note space. That's unregulated. We cannot track it. Those all cash sales were often even not even cash. Like basically they would do a deed, but no cash transacted hands. And so I could go on for probably about 10 hours about how each of these reporting agencies report different data, and you think it's all the same, but it's really not. So like for instance, if you look at Redfin, they're going to actually look at county deeds for their sales. And they're going to look at, okay, because every time you do a home sale in the United States, you have to record a mortgage or deed. And they're going to look at that and they're going to look at the prices there of what transacted. If you are realtor.com, you're not looking at county records at all. You're looking at what's in the MLS or the multiple listing sites for which they have about 99% coverage. And so you're looking at two different views of the market, but most people think they're the same. And so when they say the people that do that all cash transaction, they're looking on public records as well. And what you had a lot of was fraud and people like, let's say I'm Johnny on the Spot LLC over here that has 20 properties. You know, I need to get rid of one. I'm gonna, so you can go pledge it on some other, facility over here. You're gonna do what looks like a cash transaction, but no cash changes hands. I mean, there was a whole bunch of this stuff going on. And so what this brings is that when the banks had all of this on their balance sheets during the last crisis, they were backed by Fannie, Freddie, Ginnie Mae, FHA, VA. And part of that meant that you had to cut the grass every 30 days. You had to winterize the property. You had to take care of any ordinance violations. You have to pay a vacant property registration fee. So all of this stuff, you have to upkeep the property so it looked like somebody lives there. Well, for all these investors, none of that's going to happen. And in my travels across the country, I've already seen, instances of blight, abandoned new home construction sites, abandoned properties. And this is going to become more and more of a problem. And the counties are going to need to act quickly. And so for those, although my base case is, we're not going to have the type of price declines that are going to be meaningful this year, you still would be able to get deals by doing things like looking at delinquent property taxes, these abandoned properties, these pre-foreclosures, but it's also still very risky because if you buy before the market bottoms, that is the risk. It really depends on your long-term plan. But because of this, the counties are going to have a real problem on their hand that they don't know how to deal with. They're not used to foreclosing this much. The banks are the ones that, did it before.
Okay, understood. So you think the foreclosures are going to be more county-led than bank-led this time?
I think there going to be a lot more of those for sure. I think that you're seeing investors abandon properties, and because a lot of these were things called straw buyers or people that don't even exist, there's no skin off their nose. They just walk away. And so, I mean, we saw a lot of this during the last crisis. It's nobody really, I think, did a great follow-up study, but I think that in actuality, we had a lot of the similar stuff last time. It got lost in the fog of war. We've been tracking those all cash sales a lot better this time around.
Let me see if I can articulate this back to you, make sure I've got a good understanding of it. They may be registered as all cash sales, but what you're saying is there's financiers behind them, all different kinds from all different places. And so the investor who owns the property, or the entity that owns the property, it's not like they have 100% equity. They still may only have 5, 10, 15, 20%, or if the price goes down, negative. And so at that point, they're like, okay, I'm hemorrhaging on all of these costs, winterizing, utilities, all that kind of stuff. There's no equity here for me anyway. I'm underwater. And so just like in 2008, people were underwater with the banks. Well, now they're underwater with their investors, but it's not shown. And so they're like,
right.
Screw it. Why am I here? I got to go and make a living. And they just peace out.
That's right.
And then just hand the properties back. So, okay.
Yeah.
So the data shows that we investors, the community, has a lot more equity than we actually do because of this. Because that's the main argument people say to us. It's like, this is nothing like 2008. In 2008, there was no equity. But the numbers show that we do have equity this time. But you're saying, in actual fact, that's not true at all.
Right. And so, so I would say we're more like late 2006, early 2007 right now. And I think this is where people get lost. It's like, no, this isn't what happened in 2008 yet. But essentially, the thing people forget about is that all of those borrowers, over 8 million who were on forbearance, during COVID, they could miss up to 18 payments. So think about that, average maybe $2,000 payment. the workout for that was either you sell your home or you enter into something called a payment deferral or a partial claim. And this is boring stuff, but it's really important. But both of those programs, they were just different. Fannie Freddie was the payment deferral, FHA, VA were the partial claim. You would take that 18 months of payments and you would put it at the back of the loan in a non-interest bearing lien that is not recorded on record. Okay. And so a lot of these folks, and I just tweeted something about this last week because they're like, wait, I'm already underwater. Nobody told me that. That's right. Because when you look at the combined loan to value of that non interest bearing lien plus your original mortgage, you are now underwater. And unfortunately, because of the abysmal technology in mortgage, I mean, it's worse than your greatest imagination, like 1950 IBM. I mean, that's how bad it is. As a lot of times on these billing statements, it wasn't called out what your combined outstanding was. Now, that wasn't everybody, but that did happen. And so we've already had equity withdrawal. In fact, I just feel like we're doing everything in reverse of last time. Like we did what some of the solutions were prior to getting to the crisis. And by withdrawing that equities was very similar to what we called HARP back after the crisis. And so not only do I think that we're all a little delusional, another study, again, this is very boring, but another study by Fannie Mae they looked at 7 million comparables from the recent origination years, and 55% of appraisals were not taking into consideration seller concessions, such as these rate buy downs, such as these incentives. And so another way to say that is at least 55% of the time, comparables were inflated. And so anybody that thinks that their house is actually worth their estimate, I ask you just to list it and then let's have a conversation. Because it's just the reality of that equity is you don't have that equity until you can sell it.
Let
And
me
people
just
get very
explain that. You kind of
confused about that.
breezed over that. Can I just explain that for the viewers, if you don't mind? Because that is important.
Sure.
That's a really widespread practice right now. It's another one of these instances of where when you go and look at the data and you look at the number, it looks okay, but it's not. So what was happening with a new birth? Someone buys a farm, slices it up into properties, turns it into 50 houses. They go to sell those houses. They can't sell the houses at the price they need to make a profit. Right. So what they do is they start slashing, but if they slash the price, then that lower price gets recorded. And now all of the other homes they're trying to sell, they can't sell at that price because there's now a comparable. So what they would do is they would say, listen, you don't want to buy this house for $300,000 if you have to go and get an 8% mortgage. What if I pay $30,000, $40,000, $50,000 to the bank to bring your interest rate down to 5% and you only pay 5%? Now will you buy the house for $300,000? Like, oh, let's just chop my payment down by a third. That's interesting. And so the property gets marked as being sold for $300,000. What is not obvious is these concessions that you're talking about, which is, oh, they spent $30,000, $40,000, $50,000 buying down the rate. Now, obviously, for it to be a valid comparison, they should take that into account, but they don't because it's not easily accessible information.
Right. That's exactly right. Very good explanation.
Gotcha. So we've got so the theme I'm hearing here is the data is obscured and misleading. We've
Correct.
got they're selling properties for $20,000, $30,000, $40,000, $50,000 less than what they're saying they are, but they're just hiding it in various different ways and locations,
Right.
selling it in the family, buying down rates, etc. And then there was the other issue that you just walked to, which is now I'm blanking on. I can't think of it. The other one you just talked about. It's lost it, but it was the same concept.
Oh, the payment deferral and
the payment
the
deferral is
pulling out
not.
of, yeah.
Yeah, there's no lien on the property, and it's not even written in the statements. So therefore, people think they have more equity in their house than they do, but that equity is gone. All right. So while we're on the theme of the data being invalid and misleading, are there other things that you can share with us that it has the same concept?
Yeah. So, part of when I came back from the road, I just couldn't understand because I was looking at all the same data and, it felt incomplete. And so after I got a few sort of examples of like, wait, why isn't this listed on the MLS? Why doesn't Realtor have this or why doesn't Zillow? I did a lot of diving into these data series. And I think A lot of people don't realize that Realtor.com is who provides the inventory and sales information to Fred. So in reality, this is a vested interest providing information to a government entity. You know, also owned, same parent as the Wall Street Journal. And so I'm not even saying that people are doing this on purpose. I just think that we've gotten to a certain place in the data that it's become almost useless because it's got tiny little perspectives. And so you have to triangulate and look at more sets of data. But I would say the biggest thing that I've noticed, beyond the fact that Realtor likes to act like it has all the inventory out there, and it clearly does not. It would not answer pointed questions about the inventory it was missing, which by far they had way more than Zillow and Redfin and others. Don't get me wrong. But I've realized too that in all these series, they use these seasonal adjustment numbers. And you take something like the new home survey, which feeds new construction sales, it feeds permits. We know based on several studies that participation in any survey has gone down from COVID. Also, we're asking the builders what they sold a property. I mean, they literally pencil it in. I'm not kidding. Like it's a little box, they type it in. There's no verification of that. Additionally, there's all kinds of crazy things like the Fed and in that census survey, they don't track cancellation for new builds. So what you can actually see in the new build numbers is that inventory just growing and not selling, but no one's talking about it. But back to the seasonal adjustments, you can just look and see that if you look to last year on new home sales, existing sales, what they talk about, what every single article is written about in the paper is not what happened, but the adjustment they made to the model. And so you heard in February that existing home sales were down. No, they weren't. They weren't. And this then made everybody think something that was not true. It was just an adjustment to the model. And so, I mean, it's just we are in a data dungeon for multiple reasons, but the same reason that most of our institutions are failing us, it's the same. And so it's really important that you kind of get multiple sets of data before you go out there thinking you have any idea what's going on in the housing market. Because if you read my Substack, you've probably seen where I like to take, when we get a new data series, I take multiple headlines and you can see that all of them are often very contradictory, and definitely, you know, a vested interest is putting that message out.
Understood. So, all right, now I think we have, unless there's anything else that you want to add, some, you know, big red warning lights, we'll move on to what's happening and what's happened and start moving into some forecasting. And it's like what's going to happen.
Sure.
You've kind of alluded that we're in the 2006, 2007 phase right now. I translate that to mean the 2008 horrific parts coming up in our near future. Would you like to elaborate on that and exactly how you think the dominoes are going to fall?
Yeah. So, you know, we all remember 2008 for what happened in the news, but honestly, the default crisis really, you know, peaked in 2010, 11, and 12. Because, you know, what we were dealing with in 2008 were the subprime borrowers, or what I call non-traditional borrowers. And then this is what so many people don't understand about 2008, and it's why they get confused, is that is where it started. But then what happened was 2010, you had people trying to take out equity through refi because rates were lower. And then you had your prime borrower who was just fine. They were a wonderful 750 credit score. They had a low LTV, but then something happened, like a job loss, or same thing, property taxes went up, insurance went up, and then they started coming under stress. And just as you need that equity to tap into, your prices started to come down, and that's really what happened in 2008. So, and all this distress just escalated that because nobody was selling foreclosures, guys. This is what so many people misunderstand. Like, yeah, maybe initially, but then by the time you're in 2010, 11, 12, most of the big servicers were on hold. You weren't allowed to sell those properties. And then it started changing. Okay. So I just think what's to come. And when I look at existing home sales, or actually when I look at total sales, we're kind of in this uh, above 2008, below 2008, above 2007. So we're kind of like right in in terms of the actual origination, what's happening in the market. But what I see happening, because this is an election year, and yes, sometimes you can't control this. You can't. Like, it's just the genie's gonna be out of the bottle. But I think that anything you can do to keep this from erupting, that's what's going to happen. Like this new Freddie proposal to do closed-in second lanes through the capital markets, that is a way to try to keep things from falling apart. But you've got FHA delinquency already at over 11%. Those are lower credit score borrowers, but it's basically government-backed subprime. And so it's happening. And in my books, I'm seeing the prime borrowers already come under stress as well. So what I see for this year is probably, home prices come down very slightly, around 5% on an aggregate basis nationally. But 2025 is going to be the biggest drop. In my model right now, it's about a 12% drop. And then you have a couple more years of minor corrections keep coming, so this is going to be a 3 to 5 year cycle, but I think honestly we'll bottom out probably in that 5th year or so. Still, there will be opportunities and deals along the way if you're smart about it. And really what it comes down to is understanding what your goals are. Because a lot of people, and a goal can't just be, I just want to make a lot of money. It's got to be, okay, how much exactly? and how is this property going to do it? So that's kind of my long-term perspective. Of course, any exogenous event like a war, the UFOs, whatever, this could change the trajectory. But this is honestly how I kind of see things playing out over the next several years.
In 2008, we saw that the government around the world, but let's focus on the US, they debated about doing something completely unprecedented, which was this huge bailout situation, billions of dollars printed. Sorry, it's billions of trillions. Anyway, stupid amounts of money printed. But there was a huge debate about it. It was an unprecedented thing that they had done. We saw in COVID that they took no such time to have such a debate. That debate had been had, and at the drop of a hat, just started printing even more unprecedented amounts of money. Is it your belief that they're just going to, at the first sign of danger, they're just going to print insane amounts of money to rescue it, or are they going to let 2008 happen again?
So I think that what's going to happen, if it happens before we have some sort of credit crisis or credit event before November, they will print everything. They will do everything they have to do. I mean, this feels very high stakes to me this year. And I think that, so they're going to do everything they can unless they realize that capitulation is the only way out, meaning like there's nothing they can do to save it. Like they're going to have to capitulate and then look like kind of the heroes, more like think about it, belt and suspend, like we're all going to have to do some hard things, that kind of message, if it got too big, that would be, yeah. But I think that once November happens, whoever gets elected, they are not going to be able to keep funding this. It is just too big. The commercial real estate crisis, which I believe commercial and residential are inextricably linked, and they go together. But the commercial real estate crisis itself, like all you have to do is go to one or two of these cities, walk around, and you realize that this is way bigger than, and you think everybody's talking about it, but it is much bigger than what people are talking about. New York was deserted. I spent a week there. I lived there for 7 years. And so this is all over the country. And, this is why I'm bullish bulldozers. But, and I do see a ton of government programs that'll come in to save everything, right? Like, we might all be going to work at one of these places that will be tearing down buildings, if we're out of jobs. Like, I do believe government's going to get involved in big ways. But I don't think it's just going to be, I think it's going to be more of this fiscal stimulus and more of like what we saw in the Inflation Reduction Act, which is we know is a joke of a name, but
it certainly was. Pardon me. So yes, plenty more money printing. So that, it kind of begs the question, will we, like, well, I agree they can't fund it, but like, only at the expense of inflation, right? So, but this time, so in 2008, it's like, okay, this big debate: should we do it? Should we not? Blah blah blah. They did it. 2020 with the COVID, no debate. Let's just do it. Paying the price for it now with very high inflation. That next time that next debate comes around, now all of a sudden it's like, well, I think there's at least an understanding of damned if we do, damned if we don't. It's like, oh, if we print, and it's going to take 10 trillion or more this time around to, and then you're just going to get into silly inflation. So, well, what does the real estate investor do? Is it's best to sit on the side, or because if you hold off and you're in cash and then they print all this money to save it, you've got the inflation battle. What does the average investor do in your opinion?
Well, so those that believe with all that printing that we're going to reach these, unprecedented, hyperinflation, I believe we'll have a social crisis before then. I mean, people are just suffering too much. And so I think that sure they could try that, but there will be a social crisis. There will be unrest. And I think this is what a lot of the inflationistas don't understand, because most of them don't spend time with the bottom 80%. I live here in Tennessee, and I can tell you, like, people are not going to stand for hyperinflation. And so I think that, that is what most are missing. And I think that some people realize this. I think they get it, that if they keep going that, so I think somehow it's going to be through social unrest, a combination of them trying. If you think about it and go back to the Great Depression, the reason it lasted so long was because government tried a whole bunch of stupid stuff, like,
Yep.
those tariffs, and we're doing all the same things again. And so I think there's going to be some failed policies, but ultimately, through financial repression or war, we will get out of it. But if I was a real estate investor, I certainly, with how much financial repression I'm seeing right now and things that are happening out in places like California and New York, where you can't raise rent, where you can't evict, where you can't, I mean, in California, you have to have X percentage for affordable housing, no matter where you build. I mean, you can't go to the bathroom like without the government involved. And if you're constructing, it's very similar. And so I think if I were an investor right now, I would not want to be participating when I see so much financial repression already existing today. And I think so few understand that a lot of housing is already propped up by the government. And I mean, is that where you want to participate? Unless, of course, you get in on one of their affordable housing programs and feel comfortable about that position. And because some people live there in that place.
Yeah.
Mm.
So guys like Kenny McElroy are saying yes, like all the things that you're saying, and that there's going to be trouble. However, in 2, 3, 4, 5 years, he's anticipating massive undersupply. Is that your opinion as well, or not?
No, and I think the people that think that way don't understand demographics. And even with immigration at the pace that we've seen in the United States, um, that it's not going to matter. Our demographics are just so abysmal. And with that affordability, so what you saw during COVID, and Harvard did a really good study about this, is we pulled forward demand, like household formation. We pulled that forward. And so what would have been a normal timeline of household formation, we kind of went crazy. Now, what you're starting to see is that's going the other direction. People, kids are moving back home, kids are moving their parents in, things of that nature. And so, and then we're not having babies. And I think that when you look back over time, people forget what happened in the 70s when we had all this construction. Well, how in the 80s, like, how did we make it through that time? Well, women joined the workforce. We don't have anything like that in our future. In fact, the only thing that we have staring at us right now is AI, which I'm not one of these that thinks that AI is going to replace jobs tomorrow. I worked in technology for several years. Humans are still have to participate, and they are very limited in their ability to complete a product, a technology product. I can tell you from my product graveyards that I have, with several products there. And so, but it is staring at us. And so, where do these productive jobs, where are they coming from to be able to give the type of income that could really sustain a middle class life? This is where, and I really like Ken McElroy. I mean, I'm a fan of a lot of these people, but every time I ask the question, what jobs, what is coming? And we've got a negative headwind in employment with AI. So what is the tailwind besides government? And that government, I don't know about you, but I grew up in this country, and we're not going to take well to somebody telling us where we get to live, block A, section C. And so, that's where the whole social unrest sort of comes in. So, I just think that um that the idea, they're looking at old models of demographics, they're looking at old models and not our what happened in history without understanding why we got out, like women joining the workforce, and just thinking, all things being equal, we are going to be undersupplied. But they're also not realizing that in the United States we have 15 million vacant properties. These are not abandoned; these are second homes. And on top of that, you have boomers retiring at 10,000 a day who are not going to need these homes anymore, and they have second and third homes and things like that. And so in reality, we're going to be more like Japan, who had, I believe, about 11 million vacant properties all over the country. Americans are going to buy them because of this aging population. And so I think that people just aren't thinking about the demographics. And we would have to have immigration go completely on steroids to be undersupplied. And then that's with what we know. You go out there like I have on the road, and that entire countries could move here and we would still have vacancy. I mean, it is that crazy, especially in the Sun Belt states.
All right, very, very interesting. It's been very, very generous with the time you spent with me, Melody. Hopefully we can get to chat to you again soon because your updates are awesome. Why don't you let people know where they can find out about you and how they can get more of your work?
Sure. So folks can find me on X Twitter at M3_Melody, Melody. I also write a Substack, M3 Melody Substack, and YouTube, M3 Melody YouTube.
Awesome. I'll put all three of those links in the show notes below. So guys, Melody, thank you very much for being there. Guys, take care, hit like and subscribe, and let me know if you want to have Melody on here again because this stuff is really interesting to me. Take care. Bye.